Am I audible to everyone?
Yeah.
Thank you. Thank you. This is the first international webinar which we, AARVF, is organizing with the International Institute of Business Valuers. And I welcome Mr. Raymond Moran and Dr. Gopal Krishna Raju and a chartered accountant and a registered valuer, V.V. Sampath Kumar. I'd just like to give a little introduction about them. We are still waiting for Andrew Strickland. Okay, he's here. Hi, Mr. Andrew. Okay, he's just joined. In the meantime, I'll just give a...
He's entering on the right time.
Yes. I think he's just trying to enter. So I'll just won't waste much of the time, and I'll give a little intro about Raymond. Raymond, he serves on the board of IIBV and chaired its marketing committee promoting business valuation education worldwide. And he is also a managing director of Fawn Valuation Advisory. He specializes in valuations for cross-border mergers and acquisitions. That's in America, Asia Pacific, and Europe. He was also a senior VP and MD of American Appraisals Associates for Asia Pacific operations, and before that managed the firm US Real Estate and Machinery for Equipment Groups. He's contributed author to financial valuation applications and models, and published articles on valuation and bankruptcy laws and regulations in India. So I welcome Raymond.
A pleasure to be here.
Hi.
Thank you.
Hi, Andrew. Good evening from India.
Good
we
evening.
welcome you as well.
Thank you.
I'll just give a little intro about Andrew. He's a chartered accountant, and he chairs the Education and Training Committee of IIBV and is a member of its board. He has delivered training on business valuation in Saudi Arabia and Europe. He is the author of Business Valuation Manual as used in Takim, the business valuation regulatory body in Saudi Arabia, and NAVS, the Serbian Business Valuation Organization, and has delivered training in business valuation to ANEVAR, the valuation organization of Romania. Andrew has also, has several articles published in the US periodical Business Valuation Updates. So I welcome Andrew once again. And we have, all Indian valuers know about Dr. Gopal Krishna Raju. We welcome Dr. Raju. He is one of our director registered valuer of AARVF. He's a CA, CS, IP, and a registered valuer, a passionate teacher, an inspiring speaker, a motivator, and a writer, and more than 24 years of experience in the relative field. I welcome Dr. Raju. And the last but not least, we have our RP and IP V.V. Sampath Kumarji. We welcome you as well, sir. I'll just give a podium to V.V. Sampathji and Dr. Raju.
Well, before we hand over the session to the moderator, Mr. V.V. Sampath Kumar, it is a pleasure to have on board today two veterans on valuation front, CA Andrew Strickland and Mr. Valuer Raymond Moran. This is a initiative jointly by AARVF and IIBV. And out of the 26 alphabets, vowels are very, very important. And AA signifies one of the vowel, and IIBV also signifies one of the vowel. And I'm sure, and they say, majority of the women in the world, their name ends either with A or I. So therefore, both A and I are very significant alphabets. And this international webinar series also jointly with the AARVF and IIBV will be very significant because IFRS is a very important financial reporting standard followed across globally. Maybe the versions slightly differ country to country, but the majority of the pronouncements are followed in financial reporting. and especially recognition part is a very significant aspect. And the concept before recognition is the valuation. So there were times when documentation were primary to do journal entry in books of accounts, but today, in ahead of the documentation, the transaction has to be seen left and right, like how when we cross the road we see both sides and cross. The accounting world now sees back and forth, and that's where valuation takes a significant center stage under international financial reporting standards. So with this background, today we are going to start with one of the significant aspect, that is valuing an unquoted equity share of unlisted company, so which has a lot of bearing. Even though IFRS 13 on fair value measurement is a generic standard, the education material, the standard is 99 paragraph, but the educational material for IFRS 13 runs for 139 paras, exclusively only for unquoted equity share measurement. So with this brief background, let me invite veteran chartered accountant and registered valuer CA V.V. Sampath Kumar ji to take over the proceedings.
Thank you, Dr. Raju. I am delighted to be part of this great initiative, that too with the globally renowned two speakers on board, Lagulji, Gopal Krishna Raju, Dr. Gopal Krishna Raju, Raymond Moran, and Mr. Andrews. Let us go to the topic straight away. I would like to know from Mr. Raymond Moran, what is the significance of valuation under the IFRS scheme?
Well, thank you for the question. It's an honor to be here. And through the IIBV, we're very excited about this initiative, given the magnitude of India's importance in the global economy and what is happening within the valuation profession. Very exciting to be here. So IFRS is incredibly important as the valuation profession worldwide has really made great progress in improving our transparency and the quality of financial information for investors. And through the International Accounting Standards Board, which issues the International Financial Reporting Standards, this now gives us a common framework that we can do valuations for financial reporting. And examples of those valuation services might be valuations of financial instruments, they might be valuations of shares in private companies, business combinations following mergers and acquisitions, or, as very common these days, valuations for potential impairment purposes. So we are always trying to be as transparent and issuing clear financial information that we can to investors worldwide, and our profession has made tremendous progress in the past several years in doing so.
So it's very nice. It's so significant that under the given circumstances specifically, this valuation takes a lead under the global scenario with respect to the developments that is taking across the globe. That's very nice of you. And Dr. Raju, there is repeatedly a term used under the valuation, fair value. What is meant by fair value, Dr. Raju?
A very interesting question, and fair value is fairly defined everywhere, whether it is US GAAP or IFRS or the Indian accounting standards. And all these standards, they say the same, they adopt the same definition. And this particular fair value has 4 pointers, like how we have the 4 tiles here. We have 4 corners. One is the exit price. So they say price is what you pay and value is what you get. And normally a transaction price, they call it as price what is being paid. So they call it as a transaction price. So that is actually called as an entry price. Now here, in case the particular asset are sold or the liability is settled, So the first point which I want to make clarity here is fair value is the concept which is market based, not company based, not asset specific. It is market based. So this is number one. Number two, the dimension of fair value is with respect to the transaction. The transaction should be orderly transaction, meaning arm's length. So maybe if it is between related party, it is not fair value. It is related party value, or it is unfair value. So the unorderly transaction is a very important tile in the fair value dimension. So like how we have the four directions. One is the exit price. Second, the transaction should be orderly. Third most important direction is market participants. So the fair value can be from a seller's perspective. Only from seller's perspective, no. It can also be from a buyer's perspective. Buyer also will be interested on a fair value. Seller also will be interested on a fair value. So both these parties are called as the market participants. And sometimes market participant can be even a future. So they need not even close a transaction in expecting a particular transaction. Always it happens, even in marriage also. So we don't see a girl and we immediately say yes, and then the marriage happens. It is like a Tom Cruise movie.
It happens very invariably in India, Dr.
So therefore, sometimes market participant will try to find a fair value, and then the transaction will start. Then they'll say, no, I'm not interested. I'll see some other bride, and I'll not. This marriage is cancelled. So market participant also includes would-be buyer, would-be seller also. And last but not the least dimension is on a particular date. On a particular date. From an IFRS perspective, they use a term called measurement date. From an international valuation standard perspective, they use a term called valuation date. But anyhow, date is only one.
Very nice. You covered the various, dissected the terminologies involved in the fair valuation, fair value, as to asset, the arm's length price, orderly transaction, and measurement date with snippets about the marriage system and all. Thank you, Dr. Raju. I'd like to know the differences that is between quoted equity instrument valuation and that of unquoted equity instrument. Now, there are two eminent speakers. I will leave the choice to Mr. Moran or Mr. Andrew. According to them, they can take the question and come back. Convenient.
Sure. Shall I take it, Ray, and then you add to
what you can.
Yeah. I think the first thing I will say is that we have to recognize that IFRS 13 was brought in order to have a collective valuation definition, because what was happening was that international financial reporting standards were evolving and changing, and valuation was appearing in various different places in financial statements, and therefore the arrival of IFRS 13 really reflected that evolution and that change that had taken place over the previous 10 and 20 years. And I think another thing to say is that, interestingly, I think all of the people like the Securities and Exchange Commission in the USA and other people who are trying to regulate markets were becoming increasingly concerned, because they're saying, well, we've got the regulation of auditors all sewn up now. We've done a lot of work on that, but now all of a sudden we're getting valuations coming in, and what's the relationship between the people who do the valuing and the people who do the auditing? Because what one has this situation whereby valuation is becoming more and more important in international financial reporting standards. That brings with it a regulatory risk for the various regulators. So that's the first thing I say. The next thing I say is, in order to answer the question, we need to look at IFRS 13 and understand what is meant by level 1, level 2, and level 3 inputs. So if we're valuing a public company, then as long as that public company shares are traded in a deep and liquid market, market. We know what the market value is. We as valuers would be presumptuous to think that we knew more than the whole of the market, all of the market participants. The market participants as an overall body give us a value for the shares in a large company. So if we're looking at a company like Meta or Apple or Amazon, then or Exxon or indeed some of the largest Indian companies, then you have very deep and liquid markets. We valuers, we just take that valuation from the financial press, and that is the value. You then have other companies, which are public companies, but where their shares aren't traded on that regular basis. They might be traded on a matched bargain basis, whereby a market maker finds a buyer and seller and puts them together. In those circumstances, the market evidence is a lot less strong. So, but level one inputs are the prices of shares in the public markets if it is a deep and liquid public market. We then have level two inputs, and level two inputs is a fairly narrow definition, and I think it's best defined by example. If we imagine that you have a bank which has issued a 5-year bond, and that bond trades, say, a 1% premium above a 5-year government loan, then we can then look at a 7-year bond that bank has issued, which isn't traded, and we can say we therefore can look at a 7-year government bond, add 1%, and that gives us an indication of the yield we might expect on that bank bond which isn't traded. So that's a level two input. It's something that's pretty close, pretty compelling evidence relating to value. Now, the vast majority of valuations, probably 99%, I should think, are using level three inputs. And level three inputs can be defined as saying if it's not level one and it's not level two, it's level three, and level three is really everything else. And so most valuers spend most of their time valuing unquoted shares in private companies, and we're using level three inputs. And what that means is that we might say there might be, say, if we're looking at, say, a restaurant sector, there might be several public companies which are restaurants. We're looking at a far smaller company, and then when we're looking at that, we really are having to use a lot of judgment in saying if you've got a restaurant that's publicly quoted and it's trading on a price earnings ratio of 12, would that really apply to a restaurant which has only got a couple of outlets in Delhi or Mumbai or Kolkata or wherever? And that requires very, very significant judgment. And so that in that circumstance would be what's called a level three input. You might use market evidence, you might try and build up a cost of capital, which again starts off with market evidence and varies it. But all of these inputs are level three inputs. 99% of business valuation is about level three inputs. Any comments you'd wish to make, Ray, on that?
I would just add, as we continue as a profession to have as much support as possible, oftentimes in valuing these shares of privately held companies, we might come across a broker's opinion about that security, and you might think that would be a level one input, but because it's an opinion and perhaps not something with a supportable basis behind it, not necessarily a level one. So we're always trying to look for level one, but as Andrew mentions, always difficult, and indeed we tend to model these based upon other inputs.
So very nice with respect to explaining with the level 1, level 2, level 3 inputs marketly traded, or some guideline is available where huge potential for valuation is available in respect of unquoted equity instrument of this level 3, which is contributing more for the valuation profession per se. That's a very nice input. Thank you very much. Now, Dr. Raju, though we have touched the differences, we touched about the definition of the technical aspect of what is meant by unquoted equity instrument in addition to level 3 category of inputs. What is that term means?
Wonderful. I'll take you from Mr. Andrew. At the end of his point, he mentioned one very important aspect. 99% of valuation are unquoted or unlisted companies' valuation. Maybe if we take the prescription of IFRS with respect to the level 1 inputs, it's very simple. So it is actually straightforward. I'll use a word called straightforward, because if the valuation date is today, 30th of October 2022, and being a Sunday, there is no stock exchange. So I will take either the previous day or the day before, or the succeeding day's opening rates or closing rates. Simple. My job is over. Or I may go for some more prescription. Like I will take the previous 10 days, 15 days, or 52 weeks closing rates, and I can take the average. This is mere arithmetic. But the unquoted equity instrument means it is the 29th definition. So if you take the educational material of IFRS 13, out of 68 pages and 139 paras, the last is the glossary. And the 29th glossary gives the definition of unquoted equity instrument. They make one thing very clear: anything other than listed in an active market.
Oh,
so now there are two things here. Sometimes it will be listed, but it may not be active also. People may not even trade. So that also may come under unquoted, because it is listed, but you don't have people don't trade on it. So again, you have to come to level 3 only. So the word "and" is there. So it should be listed in an active market, and their price. That means if it is not listed in an active market and their price is unobservable. Unobservable means what? You only go by predictive analysis. So you have to go by their transactions, past transactions, and use the statistics to do the projections and do calibration. Even in life also, before marriage, there is no calibration. But post marriage, if we have to have harmony in life with our partner, either the husband has to calibrate with the wife, or the wife has to calibrate with the husband. So the calibration is not a new term for the husband community or valuer community. So it is very easy for us. The only thing is what to calibrate. That is the question. So therefore, a lot of calibration has to be done. But the calibration is not required for a quoted company, that is a listed company, which is an active, which has an active. That means daily it is traded. So, but the volume is very less. Whether it is US New York Stock Exchange or Indian Stock Exchange, if you take the Indian number, we have 10 lakh companies, but out of that only 5,000 are listed. So it is only 0.5%. That means 99.5% of the companies are unlisted. So what Andrew's statistics is not only UK statistics or US statistics, that also applicable for Indian statistics also.
thank you, Dr. Raji. You are very nicely touched about the live impression with respect to live examples. And you have highlighted about the listed company shares. Other than that, everything is unquoted, with the rider that it should be active also. That is the take which I am taking. Thank you very much for the point. Now, let us go a little deeper. While making the evaluation, I may adopt a practice, another person may adopt another approach. There are different approaches. I'd like to know from the speakers, what are the different approaches available in respect of evaluation?
Take that, Ray.
Yeah, you can, please.
Yeah, I'll be happy to take that. Thank you. I'm not quite certain how to equate this to chasing a woman or perhaps marriage, but I will defer to the international valuation standards published in 2022, which do not comment on either of those two previous things. But as valuers, we do tend to rely on the three primary approaches to valuation, which would be the cost approach, the market approach, and the income approach. But I will mention that there are different techniques that are used within these different approaches to value, which can be quite numerous, and perhaps we can comment upon that a bit later. But these three primary approaches, cost approach, market approach, and income approach, are the same approaches that are used also in valuations of real property, plant machinery, as well as business valuation. So they are quite universal and very well defined on behalf of putting these definitions within our reports.
That's very nice. Anything to be supplemented, Mr. Andrews?
No, I think the thing I'll say is that certainly the market and income approaches are very closely related. They are like two sides of the same coin, on the basis that if you apply a market multiple, so you take some sort of metric from the markets, then if you inverse that market multiple, you get what's called a capitalization rate, and that then leads you towards a discount rate, and a discount rate is what comes from the income approach. So we should never ever think that the market approach and the income approach are on two different planets. They're not. They are. I'll carry on with the analogy. They are closely wedded. They are like husband and wife. But they're the two sides of the same coin. So I brought a bit of marital advice into this.
Thank you very much. Dr. Raju used to tell the live examples of a family system. Our Andrew is also, thank you very much, Mr. Andrew, nicely covering about the approaches and also saying that about the two sides of a same coin about the income approach and the market approach. Dr. Raju, you wanted to say something?
They are more experienced, so their world experiences definitely will add glitter and glamour.
Yeah, thank you very much for nicely supplementing and saying your words on that. Now let us move further. Mr. Moran mentioned about, in addition to the approaches, there are various other techniques involved. What are the major two techniques involved in valuation respect of market approach, Dr. Raju?
Okay, so very simple. Let me make it. One is transaction price paid for an identical or a similar instrument. That means if it is an already transaction has been done in the past. For example, for the investing company, let us take a company like ABC, and 6 months back there was an investment done, and at that point of time they have done a valuation. So that price is already a market price. Whichever method they have adopted, they could have even adopted a cost approach, they could have even adopted an income approach, they could have even adopted a market approach. Whichever approach they have adopted, but that is a transaction price. So that the transaction is already over and it is known. And even it happens even in our life also. When we want to sell we want to buy a new car, and we already have a car and we want to sell it. So we have a Mercedes and we want to sell that Mercedes. So it's already 3-year-old. So I go to a nearby locality. Who else have recently sold that Mercedes? So that price will be taken as my transaction price, because transaction price is for an identical or a similar instrument of the investing company. So this is one model of or one method of actually IFRS doesn't use a terminology called method. Valuation standard use a term called method. Approaches, methods. But IFRS use a term called valuation techniques. So in real sense, both are same only. And the second technique in IFRS term, it is called as comparable companies valuation multiple. Actually, this is the most challenging one. Finding actually even in real life also, when we have to see the bride, comparable to it should actually be compatible. So comparable is the next one. First it should be compatible. So then only we say yes. Then otherwise majority it is no only. So finding the comparable companies valuation multiple. Of course, many multiples are there. You have to choose one among that. So comparable company can be of the same industry, same locality, and same capital structure, So many comparisons should be there. And this is a place IFRS give certain caution. At the end of the educational material, they give a paragraph called as common oversights. That means the mistakes done by valuers, and they say it is only illustrative. And in market approach, one of the first thing is what they say: inappropriate selection of comparable company. Now, easily it will be available. Say, whenever you ask some of the marriage broker to give to find the he will only give the photograph and he will say the address and phone number, but it should be compatible and comparable. So for him it is a business, but for us it is life. Same is the case here. For the investor it is life. So the valuer has to understand the company, understand the business. So always, whenever I address professionals or students, I used to say IFRS, business first, accounting next, disclosure is must. So this is in short IFRS.
That's very nice. The importance about the selection or identifying of the comparable is a challenging aspect. That's what we wanted to highlight. That's very nice. Now we have discussed about the techniques available under the market approach. I would like to know under the income approach, what are the various techniques available? Mr. Modern or Mr. Andrew? Anybody?
Well,
Andrew.
shall I start off? Yep. Yes, we're in international valuation standards. They recognise two main approaches under the income approach, and the first one is discounted cash flow techniques, and then secondly we've got the single period multiple. Now again, we can look at these two and say they are very, very closely related. They are joined at the hip. The only difference between a single period multiple of cash flows and discounted cash flows, the only difference is if you have a different rate of growth in the future. So you may have a fast growing IT business that's going to grow at 16%, and then you anticipate 12% and then 10%, and then dropping down to about 3 or 4% growth over time. Then you use discounted cash flow techniques. But if you're valuing that restaurant that's in somewhere in downtown Delhi, then essentially you might look at that and say, here I have a mature, stable business. The cash flows, the best estimate we can come up with for the cash flows in future is that they're going to increase, let us say 3% a year in rupee terms. Then what we would then do is say, well, there's no point in doing discounted cash flow techniques because we've got a constant growth rate, and therefore a single period multiple gives us exactly the same answer as if we extended those projections under discounted cash flow for, let's say, 10 years with a constant growth rate with the terminal value at the end. Mathematically, the two will come out the same together. Now, I don't know in India, so we have those two main methods under the income approach. There are then other methods which are used for the valuation of intangible assets. So, for example, for valuing intangible assets, there's the multi-period excess earnings method, there's a distributor method, there's a royalty relief method, and there are one or two other methods as well. So I don't know when we talk about the number of different methods there are under the income approach, I don't know if those are included in normal parlance. They're very, very specialist methods applicable only to intangible assets. Ray, what would you like to add?
Yeah, I would very much agree. And, the discussions about some of these techniques probably would be a wonderful subject for additional webinars in the future where we can talk about the multi-period excess earning methodology, relief from royalty, or discuss the capital asset pricing model, all wonderful topics that we could get into and should discuss on behalf of the audience.
So the techniques available by itself is a topic to be covered at length because it's an introductory thing where each technique can be a topic for a discussion. Like the volume that is available to share is so much, I agree. But I take the very important point from Mr. Andrew's presentation about the variable growth and the constant growth is the criteria to adopt discounted cash flow or single multiple. That's the technical aspect of the point. Thank you very much, Mr. Andrew, to have highlighted very nicely about it. Now, with respect to the Dr. Raju, can I adopt the combination of various approaches and evaluation? And I do that. Various approaches in a single assignment.
Well, IFRS lists out only the 3 approaches. They don't recommend the hierarchy. You first go by cost approach. Cost is not there, then go for market. Both are not there, then go for income. They don't give any hierarchy. So they use a very interesting term that one valuation technique might be more appropriate than another. So this is where the person who is implementing the standard, the valuer, has to understand the business, has to understand the circumstances, and then it is not objective, it is subjective. So they have to analyze and then select the approach. Point to be noted here, that is why a valuation report it is like a storytelling. They have to narrate what are the various approaches available, which approach I have selected, which approach I have negated, and there is a amalgam. In India, we have in Hinduism there are so many gods are there, and one very special god is the husband and wife god is called Lord Shiva and Lord Parvati, and there is a combo of Lord Shiva and Parvati. So we call in English, in Tamil, we call it as Ardhanari. So that means half man and half women. So very similar to that in valuation approach also, the standard prescribes, especially for unquoted equity instrument, market approach become comparable. Where will I go for comparable? Today we have fintech companies, agro-tech companies, and every person, every new entrepreneur, youngster, they come out with a new idea. And that idea is unique idea. I cannot go and find out, and they will not reveal that idea also. It is all IPR. So how will I know which is comparable? So each one is unique. So therefore, the combo Ardhanari approach is allowed. That method, that is called combo of I will take a little bit of income approach, little bit of market approach, sometime cost approach also, combo, and that is called as adjusted net asset method. Adjusted net asset. So this adjusted net asset is nothing but your asset minus liability only. But every asset will be fair value. Now we should not jump to a conclusion, and in the common pitfalls, last paragraph, common oversights, they make very clear observation that adjusted net asset method is not it is not cost approach. It is not book value. It is fair value. You have to take asset, for example, we have land and building. Land and building, we have to take the fair valuation, the market approach, market value of the land and building from the respective land and building valuer. Take that. Of course, your book value will be 10,000 US, 10,000 Canadian dollars, and the market value will be 18,000 Canadian dollars. So 8,000 will be the incremental value. So the adjusted net asset is 18,000. So from book value, you go to a similarly liability, but generally current asset and current liability always will be at current only. Sometimes it will be even at a discount. Okay, we have to get $1,000, 20% discount. 800 is current value. Similarly, liability. So generally, current asset and current liability will be at current only. Only the other assets, intangible assets. So they give very interesting aspects where the calibration will take. I mean, where the adjustments will take place. Where they have to be very careful with respect to net asset method. So intangible assets, non-operating assets. So all these have to be considered, and even though the name is called adjusted net asset, it is fair value of the assets only. So it is market value only. Sometimes certain assets. Out of this, certain investments also will be there. So the particular unquoted company, that is an unlisted company, they would have invested in another unlisted company. Then how do I will only have the cost there. That would have been invested 5 years back. So again, the same cycle has to be repeated. So it is not simple. Maybe in a webinar we can explain it in a simple way. But when you take the paper and do the real working, so therefore, while giving a quote for unquoted equity instrument valuation, quoted equity instrument valuation, the fee can be 1/4. But for valuation of unquoted equity instrument, it should be 4 times.
Understand, Dr. Raju, very nicely presented. I take the point. The approach is not a step-by-step approach. All the 3 approaches are available. You can take it from the platter, anything the way you want it, and put a mix of it. And you nicely highlighted about the hybrid utilization of this and that when you want to adapt the methods or the approaches involved while valuing. There is no standard tailor-made prescription under the IBS or whatever the standards and prescription. Thank you very much. And there are, when I want to invest in a company, a controlling interest, I invest certain percentage of investment to take the control of the company, which is called the controlling interest. There may be a situation where non-controlling interest is there. There is a terminology repeated, non-controlling interest, uncontrolling interest discount. What is that about? Mr. Ram, please.
I'll be happy to start, and I'll ask Andrew to comment on this. It's a wonderful topic. Really, non-controlling interest refer to the different levels of value that can be looked at within an investment, whether it's a controlling interest or a fractional interest or a minority interest that's being valued. And typically, these are referred to a discount for lack of control or a discount for lack of marketability. And of course, if you have a controlling position, you can do many more things within a company. You can possibly appoint directors to the board. You can talk about dividend payments. You can do many more things with a controlling position than you can with a minority position within a firm. So the rights that follow that are really quite different. And a discount for lack of marketability, of course, refers to the amount of liquidity that's going to be in these different levels of securities. But it really leads to some very good discussions about looking at control premiums and their applicability in calculating these discounts. And Andrew has actually spoken and written extensively on this topic. So Andrew, would you mind adding a few comments about control premiums?
But by all means, there was a business valuer in the United States called Eric Nath, and he really changed the way that we looked at so-called control premiums. And just to remind you what a control premium is, if we have a public company and it's trading at, let us say, a certain price, 10 rupees per share, and then if that company is taken over, the takeover bid might well be 13 rupees per share, so that'll be 3 rupees per share more, so that would be called a 30% premium, and people used to believe that was actually a control premium. And what Eric Nath said was, well, if you look at the markets, only 3% of companies, about public companies, get taken over each year. Why are we looking at that data, which is really an exception report? And therefore, are we not looking at very, very special circumstances which are singular to their time and place? For whatever reason, there's a company wanted to acquire that company, and they were really a special purchaser. So now we're looking at that control premium as not being a control premium, it's more of a synergistic premium. It's because the people who are prepared to pay more than the market price for shares are people for whom that share actually has a greater value than it does for the whole of the market. And what that leads to is a very interesting thought, and that is to say that whereas the market price of shares is determined by the last trade of the day, and that last trade might be for say 500 shares or 1,000 shares, whereas in fact there might be 10 million shares in issue. So the market capitalization is the total of all of those minority prices. So people used to think, the market capitalization is a minority price, and therefore there must be a control price above that. We now say there is no control price above the market price unless the acquirer can either increase the cash flows or the acquirer can reduce the amount of risk in those cash flows. If you can't do that, then why would you pay 30% more just for control? What is control worth on its own in that circumstance? And the answer really is say that control really of a public company is actually not worth very much unless you're fairly confident you can increase those cash flows. Now, the reason why all of that is relevant is because people used to use a control premium, and so a control premium of 30% would actually be converted into a discount for lack of control of 30 over 130, which is 23%. So that therefore meant that people were looking at control premium studies and using those control premium studies when they're valuing unquoted companies. They would take a public company and if they're valuing a controlling interest in a private company, they would add 30% to the metrics of the public company. And then when you're doing a discount for lack of control, the control premiums will be the source of that discount for lack of control. All of that theory, which has been in place for probably 50 or 60 or even more years, has really been overturned in the last 10 years. And it was Eric Nath who started it. There's then a body in the United States called the Appraisal Foundation, and they issued a paper called The Measurement and Application of Market Participant Acquisition Premiums. And it's not an easy title to get your tongue around. So it's a long title. The reason why it's titled like that is to say that you have to look at the market participant. If there's a control, we cannot just blithely say that there is a control premium above the market value. That control premium only exists if there's a market participant out there who's got a special need, a special reason for wanting to acquire that company. So that's the control premium. The discount for lack of control is almost like the inverse of the control premium, and therefore the information we've relied upon for the discount for lack of control is now far more difficult to use than previously. And that's really been, I think, a revolution in the last 10 years in the way that we look at control premiums and the way that we look at the discount for lack of control.
Very detailed explained about the recent trends and the change in the methodology with respect to the approaches to control premium and lack of control, that is discount. That very nicely both of you explained with what's happening in the US market, how the trend getting changed over the past decade or something. Very nice. Dr. Raju, we have talked about control premium, lack of control, or discount for lack of control, everything. Now, what is that the terminology? Discount for the lack of liquidity. Lack of liquidity.
Well, maybe in banking terminology, I have to borrow a term from there called as liquidity risk. So, especially an unquoted equity instrument, there is no market to actually do the trade, so that people can come in and see the prices and then they can bid for it. So I need to find the market myself, and what can be a USP, the unique selling point for that share. And Mr. Andrew was very nicely brought out the discount for lack of control. Because if out of 100% share, anybody is, if the company is, the stakes are diluted for 60%, people will be willing to pay some premium also because they get the control. But if it is a minority, 5%, 10% shareholder, so he will not have the control also. And getting the right party. So it is that is why liquidity doesn't mean people are shortage of funds. No, I have to find the right person to buy my 10% stakes. That is called liquidity. And what can be the USP? The only USP, there has been empirical research has been done on because as a valuer, how will I discount it? I have found the per share value either by market approach or by DCF approach. So using the performance projected, I found the present value. And divide by number of shares, I get the per share value. But the per share value, I will not get that price because he is a minority. 5% only holding, he is selling that. I will say why I will not pay that price because there will be a negotiation table. In that he will say the discount for lack of liquidity will be higher 2%, 10%, 20%, 30%, 40% if the revenues are less, if the cash flows are less. If the cash flows are more, for example, it is a restaurant business. It is a 80 to 90% full restaurant business. It is a hotel with 95% occupancy or 100% occupancy. It is cash is ringing. When cash is ringing, discount for lack of liquidity will be lowest. The only aspect will be the lack of control only because he will not have control. But the discount for lack of liquidity will be minimal. But what is the percentage? You can go by some models, or you can do some studies. You can do some illustrative approaches, or you can do some market study, or very simple, go by assumptions. And one of the key pointers in a valuation report is the assumptions of a valuer. And here, discount for lack of liquidity will be a very important assumption. And on what basis? He cannot just like that say it is 10%, 15%. He will also arrive at that 15% by giving a reasoning. That cannot be negated.
So the justification is very crucial in the methodology adopted to justify what is the percentage, why. That's why you used to tell the story. What is the background? That has to be put in place in a black and white in the document so that that is properly justified. Dr. Raju, you highlighted about adjusted net asset method in one of the methods of valuation earlier. Now, what is meant by, Dr. Raju, once again, what is meant by calibration in valuation, Dr.
Raju? We have already discussed this. Calibration is very important in life also, for harmony in family, for harmony in business, for harmony among shareholders. It is like adjustment. So now who has to adjust is a different debate. Okay. But in valuation, what do you mean by calibration? For example, your cash flows, you have the past data up to 31st March 2022. But you are going to do the valuation as of 31st October 2022. That means your cash flows require some adjustment. So here already 9 months is over. Okay, 9 now we have November, December, January, February, only 5 months is there. So 7 months is over. So you need to do that adjustment. You cannot take year cash flow. So, and you cannot say, no, I will only do from 22, 23. So calibration is required with respect to your cash flows. Number two, your past, generally what people will do is, my sales will increase by 10%, 20%, 15%. Now, what is this 10, 20? On what basis? Will you go by your own past data, or will you take the market data? Which data you will take? Either you take market data or past data, you should do some corroboration and do calibration. So for every aspect, you need to calibrate till the end. Even after arriving at the price, the discount for lack of control which you subtract, the discount for lack of liquidity what you subtract is also calibration.
Dr. Raju, sorry to interrupt, you used to tell very regularly, I remember to recollect that particular famous saying of yours, making an adjustment in accounts is a sin.
Doing an
That
adjustment,
second part, what is that?
yeah. Calibrating in financial statement is a sin, but not calibrating in valuation is a sin. Without calibration, you do a valuation, that is a sin. Which
you cannot do a proper value, we cannot arrive it at all.
Exactly. So, for example, your valuation date adjustment, you are taking a comparable company's beta. Comparable company's beta will have a different capital structure. So, you have to do the unlever and relever. That is calibration. So, it is called a levered beta. So, every data what you take from the market, you cannot just like that adopt it in my valuation. So, I have to, so it is like comparing a 7th standard boy with a 10th standard boy. So, either I have to elevate the 7th standard boy to 10th standard, or I have to bring down the 10th standard to 7th standard. So, then only I can do the comparable. The word comparable will be there. Or it will be a fair valuation. Otherwise, valuation is unfair. So in the process,
adjustment that is made to the available data to arrive at the conclusion, which is the value. That adjustments are called this particular
and
calibrations. Can I correct?
Very interesting to note.
Yeah.
In IFRS is the financial reporting standard. I repeat, IFRS is the financial reporting standard. And in a financial reporting standard, the word calibration should not be there. But in IFRS, the word is called must. Must means mandatory. Must means mandatory. So here the word they use, must calibrate the valuation technique. Para number 23, education material, IFRS 13. The word used is called must. When you use unobservable inputs, what is unobservable? I don't go to level 1, level 2, it is level 3. From the same company only I take the data, it is unobservable. So must calibrate the valuation technique so that it equals transaction price. So that is fair. Otherwise it is unfair.
Very nicely touched about the unobservable and level 3 to make these adjustments or these particular calibrations to arrive at the fair value. That's the takeaway. Very nicely explained. Dr. Raju touched about the trading multiples and transaction multiples. What are the differences, Mr. Moran or Mr. Andrew? Differences between trading multiples and that of transaction multiples.
If I start with this one, it's been largely covered already. Trading multiples are the prices that we get from the public companies, and we see their prices in the financial press. As I say, those prices are prices of small minority holdings in those companies, but they're also indicative of the value of the entirety of those companies. So if we're valuing that small restaurant in Delhi, then there may be some public companies which run restaurants, and we may think that we can use the trading multiples from the public companies in order to value that Delhi restaurant. Transaction multiples, if we stay with the same example, then in many countries of the world there are databases of transactions which have taken place. There are several problems with these databases. One of the problems with them is they'll tend to be overpopulated with companies that have been bought by public companies. And the reason why that is the case is because that evidence is there in the market place in the financial statements of those public companies. The great majority of transactions that happen with private companies is one private company buying another, and it's far more difficult to obtain that information on them. Another problem we have with these databases is that many of them just give totals, and they do not tell you what the constituent parts are that make up those totals. So for example, in the UK, there are 3 or 4 different databases, and they might say in the last quarter of 2021, the EBITDA multiple average was 6.4, but you really say, well, okay, how many companies, how many transactions made up that 6.4, and that is opaque. The information is very often not provided. So if you then find that in the first quarter of 2022, the EBITDA multiples went from 6.4 to 5.3 or to 7.2 or whatever, you don't know whether that's the market moving or whether it's just the fact that there are only small numbers of transactions being included. So transaction multiples are the other way of looking at things. So in other words, that Delhi restaurant, it finds out there was another chain of 2 restaurants in Mumbai, and that was bought by somebody, and the price that was paid was a multiple of an EBITDA multiple of, let us say, 6.5, and that therefore gives an indication of the potential value of the Delhi restaurant. I'd say that working with transaction multiples and indeed with trading multiples, using the market approach to do it properly is very hard work. You cannot just say, here are 8 companies, I'll take the median, I'll take the average, I'll take whatever. That is the lazy way to do business valuation. To really do the market approach, you have to drill down, you have to understand those 8 public companies, you have to understand those 8 or 10 transactions that you're looking at. You really need to look at the history of these companies and gain a much better understanding to apply the market approach properly. And the other thing I'll say is that international valuation standards really caution against using the trading multiples. They say you should only use that if the company you're valuing it is sufficiently similar to the public company. The vast majority of private companies will be far smaller than the public company, and it really can be quite a reach to take, say, a price earnings multiple of 14 and say, well, it's 14 for the public company, I'm going to apply a price earnings multiple of 5, because the adjustment you've gone to get from 14 to 5 is likely to be completely subjective, and really the start of 14 is largely meaningless. Ray, anything you'd like to add to that?
Oh, I think that really summarizes the challenge quite well. It's tempting to use those, but the application and how similar they are is truly the challenge in using these transaction multiples and guideline company information.
I'll say that in the USA, they probably got, well, the USA has most definitely got the largest and widest stock market in the world, and therefore you really are spoilt for choice. You have a large number of public companies to look at in any particular sector. UK, UAE, India, all other markets, they've got a much smaller set of public companies. So outside the USA, the market approach is really a challenge. In Europe, what we'll quite often do is we'll use the UK, and we'll also say use the German and the French stock markets as well in order to look at values. But none of us have that same wealth of information that is available in the USA. And that's why the market approach, I think, is more prevalent in the USA than I think it probably is anywhere else in the world. I think, Ray, would you think that was the case?
I very much agree, and that's always a challenge. When I was living and working in China, for example, not a very transparent marketplace at all. So you're always trying as best you can to verify the levels of comparability and usage in your valuation, but often you're expanding valuations to regional or perhaps cross-continent searches, trying to find similar uses. But again, the further you go abroad or afield, the less comparable they directly are. So you have to use them with caution and with quite a bit of analysis to make them meaningful.
very nicely highlighted about the difference, and all the more your experiences you have shared in China and Europe, US, and the difficulty in analyzing the data which is not available in other countries, available in US. These are the points where, in spite of the availability, the analysis that matters much while coming at the conclusion. Very nicely and a detailed explanation both of you. Now, what are the commonly used valuation multiples, Dr. Raju? Multiples, market multiples, valuation multiples.
Very simple multiple is, maybe if I have to buy a restaurant, they will say annual revenue is this much million, 2 million. So give me 2x of the revenue, annual revenue. So it is 2 million into 2, 4 million. So the valuation will be 2 times of the revenue. So 2x, 3x, 4x, 5x. So then I compare with the comparables. So similar comparable restaurant, what was the revenue multiple? So it is called revenue multiple. Then you have book value multiple. So maybe I will go by the book value price to market. So book value is 18 rupees and maybe the market value is 90 rupees. So 5x. So that is one another model. So revenue X, book value X, earnings X. Earnings is net profit. So which is your earnings after tax or profit after tax. So on that, I can go with the multiple of 10x, 15x, 20x. Again, the 10x or 20x, I will go by a market approach. So I have to go by, I cannot go by a thumb rule. So that again, I have to do empirical studies and then arrive at that. I have to conclude what will be a reasonable multiple. So first, you have to fix the multiple. This you have various options that I have given right now: revenue multiple, book value multiple, earnings multiple. Then you can even go by your EBITDA multiple or EBITDA. So EBITDA. So EBITDA. So depreciation and amortization. So without depreciation only, maybe amortization I will take, or EBIT multiple. So all these three are with respect to EBIT. So either EBIT to valuation or EBITDA valuation or EBIT DA. So any of these three I can adopt. But majority is the EBITDA multiple. So depreciation as well as the amortization. In terms, it is called as the cash profit before interest, tax, depreciation, and amortization. So that means that is equivalent to the enterprise value. So that is the most appropriate. So valuation multiple. So EBITDA to enterprise value. So we have the equity value, because equity value is after your debt subtraction. So here, since it is EBITDA, so the realistic multiple will be EBITDA to enterprise value, and that multiple, selecting the multiple, number one, and finding what should be the times, the multiple times. So what will be the X times? So the X times goes by empirical studies, market approach. So you need a comparable, you need an industry standard, you need a similar data about your similar company or a recently transacted company's multiple. Then you can go for this fix, this particular commonly used valuation multiple.
Thank you very much. And friends, we have crossed our scheduled time by a few minutes. One of the last questions: what is the significance of estimating cost of equity, cost of debt, risk-free rate, beta, and WACC, weighted average cost of capital, and the application of weights in evaluation assignment? Anyone, Raymond or Mr. Andrew?
Okay, look, I'll start. It's a very, very broad subject. What we need is I think the first thing to say is that we've just mentioned the idea of using the EBITDA multiple, the earnings before interest, tax, depreciation, and amortization. And I said that gives us an enterprise value. An enterprise value is the equity and the debt combined. Now, if we're going to do an enterprise value, then we really need a weighted average cost of capital, and the weighted average cost of capital is the cost of the equity and the cost of the debt. Now, the cost of the debt can normally be assessed relatively easily by how much the company has to pay to borrow the money for it. So it's bank loans or whatever it might be.
Yeah.
We then deduct the tax from the cost of the interest, because in most jurisdictions there's a tax deduction for interest expense. So that then means we've got the cost of the debt. The cost of the equity is rather more complex. We can either use the capital asset pricing model, or we can use the build-up method. Now, with the capital asset pricing model, that's based upon the idea that we have a risk-free rate. We have an equity risk premium, which is the premium above the risk-free rate, and that equity risk premium is moderated by a factor called beta. Now, what I have found in many evaluations of small companies is that people started making adjustments for beta. And so if we've got an equity risk premium of 5%, let's say whether your beta is 0.8 or 1.2, then you're going to move that 5% by at most 1%. So you may have got an adjusted equity risk premium of 4% or 6%, depending upon the volatility of the sector that company is in. Now, if you then add on a company-specific risk premium of 10% or 15%, you really have to say, why on earth did I use beta? Why did I do do my levered beta, my unlevered beta, and do all those calculations if the only impact is 1%, when I've actually then applied a company-specific risk premium of 10% or 15%? And people say, well, where did that 10% or 15% come from? And the answer is judgment. So the idea, I think what's actually happened in business valuation is a lot of people bury themselves in calculations such as beta and levering and unlevered beta, and they do it, I think, as a means of trying to portray to everybody, firstly, how clever they are, and secondly, how complicated their valuation methodologies are, and therefore they must be right. But if you then add on a hugely subjective further cost in terms of the equity capital, then you really have to say, what was the point of doing all that, which may have taken up half of the total time you spent on the valuation, by way of example. The next thing to say is, when you do the weighted average cost of capital, a lot of people use the weighting in the company itself. You should not use the weighting in the company itself. You should use the weighting that would be applied by market participants. So if we take an example of our deli restaurant again, the owner of that deli restaurant may say, I am never going to borrow money. I don't want to borrow money. I don't like the idea of owing money to banks. I'm going to fund all of this with money from the family. It's all going to be equity. The market might say, what you should do is, when you refurbish the restaurant, when you buy the kitchen equipment, you can use borrowed funds for half of that kitchen equipment, and that might be the market view. That therefore the weightings you apply to the equity and debt should be the market weightings, not the weightings that are applied by the owner of that restaurant business. So that I say that this is a bit like an onion that you can keep unpeeling and unpeeling and unpeeling all these questions. As Ray has said, we could run a series of webinars on each of these topics: cost of capital, CAPM, build-up method, WACC, all of this stuff. There's a huge amount of material there, but that's just a very quick overview of estimating the cost of equity and the cost of debt. Ray?
Very nice story, Raymond. Raymond, 1 minute. Very nicely highlighted about the need to conduct on each of the topic, each of the subject, cost of equity or cost of control or WCC. They are themselves by itself heading for a big seminar or a discussion. Raymond, you can continue.
Thank you. I would love to add a comment. While we are all analysts and we can and should spend enormous amounts of time developing the empirical support for cost of equity, cost of debt, the weightings in accordance with the market, the adjustments we make for a company's specific risk. It's just as important to make certain we're looking at cash flow projections that are the other portion of a discounted cash flow. Especially, you look at the recent past where all of us have done valuations, firms dealing with COVID-19. Perhaps now we're worried about inflationary issues, possible recessions going forward. It's really crucial to make certain we're understanding those cash flow projections, the reasons for them. Are they reasonable? Are they in accordance with the market, other companies' projections, to make certain we're correctly looking at everything and not just trying to account for this by applying some additional risk because of these factors.
Yeah.
Very nice. Very Raju, Dr. Raju wants to supplement anything about the last question.
Yeah, every aspect in valuation, whether it is selecting a risk-free rate or estimating beta and arriving at the risk premium, because we need to know what is the market return and the gap between the market return and the risk-free rate, called as a risk premium, and also estimating the cash flows. And especially if you have the forex risk, country risk, liquidity risk, business risk, all these aspects, cash flows have to be considered, keeping all this in mind, which is a Herculean task. So analyzing the past is certain techniques, but comprehending the future based on the present is a big challenge, is a very big challenge. And I agree with both the veterans' view, especially we'll have in the days forward decoding beta. We need an hour session, and how the cash flows has to be calculated. So what are all the factors to be considered in arriving at the future cash flows, so free cash flows, and how do we arrive at a discount rate? What are all the factors that will actually go around, and whether the pre-tax, post-tax cash flow impact, we need to have it in the discount rate, or how do we do it? So what are all the aspects we need to consider at the beginning to select all these attributes, because they are all the players. Whenever Mechanized Gold is a very popular film, but it is not only Mechanized Gold or that hero alone. Every villain, every co-star's role is very, very important. And if any of the co-star doesn't play well, the film is not a super hit. Same is the case with the valuation. Every single aspect has to be properly directed. So then only we'll get the ultimate result.
Nice, thank you. There are a couple of questions, Doctor. We have ran out of time. Any one question, particular question or something can be taken, Dr. Raju, please.
I will request one of the participant who has actually posed that question, Arun Kumar Sundaram. I will allow him to talk. Mr. Arun Kumar Sundaram, you have posted one question. So we will directly hear from him. So you can unmute and ask your question, Mr. Arun Kumar, and also you can share your feedback also.
Raju, have you enabled him?
Yeah, I have enabled him.
Please.
Good evening, everyone. It was a very enjoyable session. It was like a discussion which was unstructured, is what I thought, without a normal PowerPoint presentation, but it was wonderful. Thanks to all the people in the podium for providing valuable insights. So the question which I had was with respect to...
One request, Arun Kumar, kindly introduce yourself also to this forum, so that we'll also know about you and they also know us.
I'm a practicing chartered accountant, cost accountant, company secretary, and I've taken my practice recently. So I had few challenges in the valuation. With respect to fintech companies, you are also pointing out in the last part, like with respect to how we need to project cash flows, because they consider an ambitious growth rate, which we will not be able to accept at all. And we would intelligently later on do some adjustments or calibrations, as you called, in the form of a discounting, which we will do, but they would not accept it. And all of these fintech companies, the projections that they give, we cannot compare it anywhere outside, and we cannot measure them, and as to how they are giving a growth rate which is very ambitious. Example, you would have, all of us will know of Uber valuation or Ola valuation, which is very high. We will not know whether such a company would be willing to buy at a huge price. So how would we deal with such ambitious factoring which they give on the growth rate with respect to future cash flows?
Request Mr. Andrew to throw some few light.
Yes, but by all means, I'd say that for most businesses, they're probably fairly mature, and really, what's happened in the past will give you a very good insight in what is likely to happen in the future. So I will go back again to my Delhi restaurant, and the idea of saying that if the Delhi restaurant finds that most of the time in the evenings its tables are 80% occupied and it's able to charge a certain price, then that what it's done in the past is a very, very good indicator of what it's going to do in the future. How is that business going to do a lot more than really just inflationary increases in terms of its takings and everything else? So for a mature business, the past is really an anchor. It means that here we've got the reality. Here is how this business has actually performed in the past. What is it that's going to be different that enables suddenly the cash flows to double or treble with a business such as that? When you've got a business which doesn't have that history, or which is growing very, very quickly, and say you get that with startups, then startups are incredibly difficult to value. Or if you've got a business which is actually not a startup, but it's got underway and it's profitable, but it's still undergoing very, very rapid growth, then the idea of let us say, assuming 16% growth in perpetuity, just all valuation practice says that cannot happen. A business cannot grow at a greater rate than the background economy in perpetuity. So, but it certainly can grow at the short term at a faster rate. If one really doesn't have confidence in those projections, and we think this management, they're stargazing, they're looking at the sky and they're imagining things which are just not going to happen. The obvious thing to do is to challenge them and just say, how do you know that you're going to gain 50 new customers a month for the next 12 months? What data have you got to base that upon? How many customers did you gain last month? So I think the first thing to do is challenge and be prepared to find that people will find that challenge difficult. If all else fails, then you really have to say, if you've got a high rate of growth and you really don't believe it, and you don't think you should walk away from the assignment, then the way to deal with it is say, okay, you're projecting that high growth. There is a lot of risk in you achieving that high growth. I'm going to reflect that in the discount rate. So I'd say that that's not the first choice. It's not the first thing you do. I'd say if all else fails, that's what you do. So that would be my take on it. What do you think, Ray?
Yeah, I would agree. This is just a fascinating topic, valuing early stage companies, or back in the days of technology, of course, where you had very optimistic cash flow projections. It could always be a bit of a challenge. And these days in the US, there is an enormous amount of audit review time about the projections and how do you support them as you use them within your discounted cash flow analysis. We would look at analyst reports for the industry. We'd look at what other firms are projecting, and we'd have to explain why we believe these to be reasonable. So there's really quite a bit now of additional support being done in reviewing these projections, and when you go back to some of the things that happen with early stage companies, we might be looking to the marketplace in terms of what has happened when they have gone to market and some of the discount rates that you can get an idea of from some of the pricing of these firms, huge discount rates as you go forward. So it's a fascinating topic and one worthy of further discussions.
I think the other thing I'll say is that obviously if it's an IT firm, then the basic idea is that if you've got an IT product, there's very little in the way of limits in terms of the amount of growth of turnover that you achieve, especially if you're selling those products for cash or on 30 days. A lot of more conventional businesses, rapid growth is a time when they run out of cash. And therefore, there are so many businesses, a bit like the restaurant, where it's the constraints of the building, it's the limitations of the working capital. You can't fund those levels of inventories. You can't fund that debtor book with that sort of rapid cash. So I suppose the other thing I missed out is make sure the cash flow forecast bolts together properly and is consistent. You can't achieve massive sales in a credit business without having a massive increase in receivables. That's a time of maximum risk for a business. For many businesses, rapid growth is maximum risk. That's when you run out of cash.
That's good point.
Maybe I wish to add one more point. We have a standard called 110. It is a practice standard 110 by CBV, Canadian Business Valuators. In that, there are 3 types of valuation report they discuss. One is a comprehensive valuation report and estimate. Another one is a calculation report. In a calculation report, the data are, it is only calculation. That means the data are not corroborated or minimal review and no corroboration is done. In a comprehensive report, naturally the fees will be a minimum 5x or 10x of a calculation report. So a calculation report and the comprehensive report fees is both are not same. So for a comprehensive report, you mentioned very clearly that you have corroborated those data. Maybe if your the valuation is very highly pitched, then as a valuer, you have to stick on only to a calculation report and make it very clear that the data are not corroborated. It was only calculated.
That's a good supplemental, Dr. Raju, in addition to the sharing of their global practices and anything, Dr. Raju, you want to supplement?
One more last participant will.
Yeah, please.
Indu Agarwal, to kindly share your thoughts, please.
Please.
Good evening, everybody. It was a great opportunity and a very good session, which gave me an opportunity to acquire practical knowledge on various aspects of valuation. It would be great if in next sessions in near future, if we can have some practical examples and working on beta and discount rate calculations and all. So it would be enhancing our knowledge further. And today was a really knowledge enhancing session. I'm thankful to AARVF for organizing this session.
Thank you very much. Points noted, madam. That's why Dr. Raju highlighted and the other speakers also very vehemently stated the question is so simple. Not even a bird's eye. That is a kind of an overall view can be shared with respect to the one of the last question and other topics also. There is a compulsive need to go through each of the topics. The days to come, it's only the day 1 of the beginning. We have got a lot of things to do. Anyway, thank you for your question and the suggestion. We'll take it forward. Dr. Raju, anything you want to say? Yeah.
It's time for to say thanks, and I'll hand over the session back to Rahul Sharma.
Thank you, sir. Thank you so much for this lovely sessions. I think all the registered valuers and all the chartered accountants, finance field members, and all other asset class valuers, I think they have really enjoyed this session. And I thank you, Andrew. Thank you, Raymond, for this wonderful time. Thank you, CA Sampath sir. It was first time we had a session with you. Thank you so much. And last but not least, thank you, Dr. Raju. for this wonderful session. And again, we are going to plan the next month session, and I'm sure it will again going to be a very exciting session. Thank you once
Thank you
again.
very much. Thank you. Thank you.
Thank you, Mr. Raymond, and
Thank
thank you, Mr. Andrew, and also Mr. Rahul and Mr. Sampath.
Thank you,
Thank
Mr.
you, sir.
Rahul. Thank you, Mr. Raymond, and thank you.